Welcome to my channel. This is CA Rakhi Agarwal. Today's topic is related to Indian Accounting Standard 34, which deals with interim financial reporting. What do you mean by interim financial reporting? It's a reporting related to quarter reporting, half yearly reporting, or 9 month reporting, other than the full year report. Start. What we will going to discuss in this standard, the content of these standards are: firstly we will discuss about the objective of this standard, what was the purpose of this standard. Then we will discuss about scope, to whom it was included or applicable and not applicable. Then we will discuss some important definitions, then recognition criteria, then measurement principles and disclosure. The objective of these standard, objective of interim financial reporting, that is Ind AS 34. This standard prescribes minimum disclosure requirement and principles for recognition and measurements in interim financial reporting. This standard prescribe us the minimum disclosure requirement. The disclosure requirements are very minimal. Like we have to disclose only the condensed form, the balance sheet, profit and loss account, statement of change in equities, statement of cash flows in a condensed form. But also there is not mandatory that they will disclose in a condensed form, but minimum disclosures are required in interim financial statement, not as we are preparing in the financial statement, annual financial. That much information is not required in interim financial. Limited informations are required in interim financial reporting. So minimum disclosures are required, and principles for recognition and measurements in IFR means interim financial reporting. How they will recognize and what are their measurement criteria. These are the objective of this standard. And then this standard does not mandate an entity when to prepare interim financial reporting. This standard prescribes how to prepare interim financial means this standard does not mandate, does not compulsorily that the company needs to prepare interim finance. This standard does not force any entity to prepare interim financial reporting, but uh, means there is no such. This standard does not say that there is a regulatory compliances for preparing IFR, but these standards prescribe the entity to how to prepare IFR. This standard does not prescribe that this and IFR is required to be prepared, but this standard prescribe how IFR is prepared if it is required by any other laws or any other statutes. Like if it is required by there is a requirement of SEBI LODR to prepare interim financial report, then this standard helps the entity to prepare how to prepare the IFR. So this standard generally describes the process of preparing IFR, but there is no such regulatory requirement. This standard does not say that no, you have to prepare. If there is any regulatory requirement by any other any other statutes or any other legal requirements is there, then the standard help to prepare IM. As per SEBI LODR, all the listed companies are required to prepare quarterly, half yearly, or 9 months reporting as per the guidance available in Ind AS 34. But Ind AS 34 does not mandate a company to prepare IFS. Indian financial statement does not mandate by this standard, but they provide guidance to prepare IFS as required by SEBI, LODR or any other legal. Applicability. To whom this standard is applicable? Ind AS 34 is applicable to the interim financial statement and the results as per SEBI requirement, because the results of the SEBI requirement is extracted or prepared from these financial. Means the SEBI requirement results are prepared from or extracted from these interim financial statements. If it is required by SEBI or LODR or decided by the company to prepare that, this standard is applicable. Means if the IFR is required by SEBI LODR or it was itself decided by the company to prepare interim financial statement, then they have to follow this standard, and this standard is applicable for that. Now, what is the definition of financial reporting? Reporting of financial information in a structured way following some rules and principles. Means financial reporting means in a proper way, in a structured way, all the reportings are to be done with following rules and principles. Then that is the definition. That is, for example, financial statement of any company by following every kind of rules, guidance, available accounting standards, principles, all they will follow to prepare financial statement. That is the definition of financial reporting. Now we will discuss some case study, some examples like serial number, particulars, date of incorporation, reporting date, whether interim period or not, that is as per Ind AS 34, or reason. What was the reason? Suppose company has incorporated. On date of incorporation of that company is 1st September 2021, and the reporting date will be 31st March 2022. From the date of incorporation till the reporting date, there is a 6 months period. Whether this period covers interim period, this period is known as an interim period. No. Why? Because interim period, this is a 6 month period as we know, but these are not an interim period, because the reason is that because the company has not chosen the period of less than 1 year. There is no 1 year concept, because in first time balance sheet is prepared for the period of 6 months. So this is not a 1 year period from which the 3 months quarter or half yearly quarter is selected. It's a 6 months period. So because the company has not chosen the period of less than 1 year, rather than company has to prepare first financial statement which is less than a year due to incorporating during the year. Because they has to prepare 6 months balance sheet, they had not required to select from the 1 year financial statement some period. If in 1 year financial statement 3 months is to be selected, or 6 months is to be selected, or 9 months is to be selected, then that are covered under interim. That is known as interim period. But itself they are preparing 6 months balance sheet, that is not an interim period, because the company has to prepare, the first financial statement which is less than a year due to incorporating nature. The second case study, in case of company's liquidation, the liquidation takes place on 30th 9 2021, that is 30th September, and the reporting date will be 31st March 2022. Whether these period are covered as an interim period, answer is no. Why? Because the company has not chosen the period of less than 1 year. Rather, the company has to prepare the last financial statement. This is the last financial statement which the company is required to prepare, because the company is no more exist as of due to liquidation, which is less than a year due to liquidation of the entity. So company is no more listed in the SEBI, so company is not required to prepare the interim financial statement because of the liquidation, and these period are also not covered because the companies get liquidated as on 30th September 2021. And if the company is, suppose in case of consolidation, if the parent company is listed company and its subsidiary is get delisted, then subsidiary is not required to prepare interim financial statement, But if it was required by the parent company to submit the interim financial statement for consolidation purpose, then they has to prepare the subsidiary is required to prepare interim financial statement for holding for consolidation purpose. Now some important definitions. What do you mean by interim period? Interim period is a period which is less than a year, means less than 1 year, say quarterly, half yearly, 9-month period is considered as an interim period. Interim financial reporting, the financial report for a period less than 1 year, that is known as an interim financial report, which is of two types, that is complete set of financial statement or condensed form of financial statement. If the complete set of financial statement is to be prepared, like we are preparing an annual financial statement, we are also, there is an option to prepare in the interim financial report. They should, they, if they require, they will prepare complete set of financial statement, and another option will be to prepare condensed set of finance, in which the minimum disclosure requirement is to be submitted. Complete set of financial statement, like we prepare annual period, like we are preparing annually the financial statement as per Ind AS 1, like balance sheet, statement of profit and loss, statement of change in equity, statement of cash flows, notes to accounts. All these are the complete set with full disclosure. Full set of financial statement uh, is is prepared under complete set of financial statement, and in condensed set of financial statement, which is required as per Ind AS 34, that is we will prepare condensed form of balance sheet, that is minimum disclosures is to be given, minimum, like only the heading of the financial statement balance sheet is required to be given. Condensed set of statement of profit and loss account, condensed statement of cash flows, like we have to disclose, does not require to disclose the sub items, only the head of the items, like cash flows from operating activity, cash flow for financial activity, cash flow investing activity. In total we are required to disclose, and quarterly, half yearly, 9 months we are required to disclose. Condensed statement of change in equity, and some significant notes or important unlimited notes or some material notes is to be required to be given as per Ind AS 34. So there are two interim financial reporting, two forms of interim financial reporting are there, that is complete set or condensed form of financial statement. For preparing the condensed set of financial statement, the component of financial statement require the presentation of major heading and subheading of the last annual fine. Only major head and subhead is required, which is collected from the last annual financial statement. Now, a period for which IFRS, interim financial statement, is required to be presented. We had taken the example of Infosys. This is the format how they are preparing their quarter, 3 months interim financial statement, 6 months interim financial statement, and 9 months interim financial statement. So let's discuss. This is the 3 months financial statement of Infosys Limited. The particulars, like they are presenting the balance sheet for first 3 months, like from 1st April to 30th June. They are preparing their balance sheet from 1st April 2022 to 30th June 2022 for the current year, and comparative periods are also required to be given, and comparative period of balance sheet will be always be the last audited balance sheet, and that will be 31st March 2020. And in profit and loss account, the current period will be from 1st April 2022 to 30th June 2022, and the comparative figure will be last year's quarter figure, like from 1st April 2021 to 30th June last year's same quarter. So that will be the comparative figure. In this year, in the current year, the quarter will be from April to June, and the comparative figure will be in PL the last year's quarter, that is same quarter, that will be April to June. And the statement of change equity will be the same period, that is from 1st April to 30 June, and the comparative figure will be the last year's figure of the that quarter, that is April 21 to June 21, and the cash flow will be April 22 to June 22, and comparative figure will be April 21 to June 20. Only the balance sheet, in the balance sheet the comparative figure will be the last audited balance sheet. Last year's means 31st March 20. We have taken the example of Infosys for the period 30th September 2022. The IFRS Interim Financial Reporting is required to be presented in this manner by the Infosys. That is, they are given the quarter ended figures and half year ended figures and audited figures, year ended audited figures. They had prepared a balance sheet for the period from 1st April 2022 to 30th September 2022 in the current period, and comparative figure balance sheet figure will be 31st March 2022, that is the audited financial statement. Profit and loss account is to be prepared for 3 months and 6 months, that is quarter ended interim financial statement. That quarter is the relevant quarter of this period, means the current current 3 months for this half year period. Current quarter will be the from 1st July 2022 to 30th September 2022, and the comparative figure will be the last year's same quarter, that is from 1st July 2021 to 30th September 2021. And comparative figure is also of the last quarter of the current year. Last quarter of the current year means 1st April 2022 to 30th June 2022. And in half yearly also means 6 months reporting also, they are required to given the from 1st April 2022 to 30th September 2022, and in comparative figure they required to give the last year's half year reporting, like 1st April 2021 to 30th September 2021. And statement of change in equity is required to be prepared for this period, that is from 1st April to 30th September, and cash flows is also from 1st April to 30th September, and comparative figure will be from the 1st April 2021 to 30th September 21. 9 months statement is also required to be given. In this way also the Infosys has given their reporting, 9 months reporting for the period 31st December 2022. Like they had prepared the quarter ended interim financial statement and 9 months ended interim financial statement. Quarter ended May balance sheet will be 1st April to 31st December, and comparative figure will be the audited figure, that is 31st March 2020. Profit and loss for the quarter ended means the current quarter of the relevant 9 months. Current quarter of the relevant 9 months means from 1st October to 31st December or 2022, and the comparative figure will be the last year's current quarter, that is 1st October 21 to 31st December, and comparative figure will also be given of the last quarter, the previous quarter, that is the previous quarter will be 1st July 2022 to 30th September 2022, and in 9 months they are required to give a 1st April 2022 to, that is 9 months period financials, that is the profit and loss account to 31st 12 2022, and in comparative figure, that is the last year's comparatives 1st April 2021 to 31st December 2021. Then statement of change in equity will be the from 1st April 2022 to 31st 12 2022 of in the current period, and in comparative period 1st April 2021 to 31st December 2021. Cash flows 1st April 2022 to 31st 12 2022, and the comparative figure will be 1st April 2021 to 31st December 2021. The due date of filing LR, that is limited review report to SEBI. Regulation as per 33(3)(a), compliances or disclosure or reporting. Financial results along with LR or auditor's report. Timeline for submitting the report will be 45 days from the end of quarter. End of the quarter means if April to June the quarter is from, that is 45 days. That is 1 month is till 14th August. They have to submit the limited review report to the SEBI for financial results or auditor report to the SEBI for the quarter 1. Quarter 2 ending on September, so the time period will be 45 days from the end of the quarter, that is 14th November. And for quarter 3, 14th February, and for quarter 4, that is ending on March, due date will be 15th of May. That is 45 days is the period from the end of the quarter. Now significant event and transaction. What do you mean? The disclosures which are required to be given. Some significant events and transactions like notes related to any significant events and transaction are required to be disclosed. If any transaction are significant for that quarter, then that is required to be disclosed in the interim financial statement. Some of the examples of that disclosures are as follow. Following disclosures are required to be made if material. Material means if they are important. Suppose the transaction of that event is not material, then they are not required to be given. But the transaction of that events are material, they are significant, they are means where suppose 1000 is not material, but if the turnover of the company is in crores, but if the transaction is of crores, then they are material for that. For 1000 is not material, but they are if the transaction or event is in crores, then they are material. Even they are if the transaction is in lakhs, or then they are also material. Write down inventory to NRV or reversal of impairment of inventory. If there is a written down inventory due to any unbearable situation or due to any situation due to natural cause or disaster, if there is a written down inventory which is not under the control of the management, or if there is any reversal of impairments of inventory, that is impairment and reversal of impairment as per Ind AS 2, then if the transaction is material, then they are required to be disclosed. Impairment of financial assets as well as non-financial assets. This is as per Ind AS 109 and Ind AS 36. If there is any impairment on financial assets like equities, debentures, preferentials, or non-financial assets like there is a trade receivable, investment in equities, investment in debentures. If there is any impairment on that, then it will be reported, and that impairment is significant, important or material, then it will be required to be reported or disclosed. Otherwise, if not significant, then not required to be disclosed. Reversal of any provision for restructuring. Restructuring is important. During that quarter, any restructuring takes place, and reversal of any provisions for restructuring takes place as per Ind AS 37, then they has to required to disclose. If any acquisition and disposal of PP is there during that period, during interim period, then that is to be required to be disclosed. If any capital commitment is there, capital commitment means any order is there, any sales order or purchase order is there, and if they had made purchase of any 2 crores or 3 crores items and remaining items are pending, so it's a commitment for the company. So any capital commitment is there. So that is also, and that capital commitment is of material nature, then it is required to be disclosed. Any litigation, if settled as per Ind AS 37, then that is also required to be during that interim period, then that is also required to be disclosed. And litigation with any, like income tax litigation, any ROC related litigation, any sales tax related litigation, any excise duty related litigation, any custom duty related, any litigation with the department is, if settled during that interim period, then it is required to be disclosed. Or if any contingent liability and contingent asset is there during that period, then is also required to be disclosed as per Ind AS 37. And if any correction of prior period errors is done during that interim period, then also required to be disclosed. If there is a change in business or economic environment which has an impact on the fair value of the financial statements and liabilities, then also required to be disclosed. Any default in loan covenant, both short term or long term, any default takes place due to which during this period, interim period, then it is required to be disclosed. Related party disclosure as per Ind AS 24 is required to be disclosed. Change in the classification of financial assets and liabilities, that as per Ind AS 109, if there is a change in classification from OCI to fair value ABTPL, if there is change in classification, then it is required to be disclosed. If there is a transfer between the input hierarchy in the financial assets or liabilities, input hierarchy means, suppose in investment there is some quoted values are there which is required to be disclosed or valued as per, if the quoted are there, if the quoted investments are there, they are required to be valued as per the market on the date the transaction takes place, because if the quoted investment is there, the market price will always change or change on day to day. And if the unquoted shares are there, they are valued as per break even, book value, like fair value as per the financial. And some are there which are required to be disclosed as per the valuation, as per valuation done by the valuer. So these are the transfers between hierarchy, input hierarchy in the financial assets or liabilities. Like if they are quoted, they are level 1 hierarchy. If they are unquoted, they are level 2 hierarchy. And if it is done by the valuer, then it is a level 3 hierarchy. So if any change in hierarchy takes place, then it is required to be disclosed. If any change takes place during this interim financial reporting period, then they are required to be disclosed in the IFS, Interim Financial Statement. Other disclosures are also required to be given. Other disclosures are, if there is a statement that the same accounting policy or method of computation is followed in the interim financial statement as in the last annual financial statement. The same accounting policies or consistent accounting policies or computations is to be followed in the interim financial reporting as they had followed in their annual financial reporting. But if they adopted the different accounting policy in comparison to the last annual financial statement, the nature and impact of such change is required to be disclosed. Then they are also required to explain the seasonality or a cyclic nature of operation. If there is any seasonal or cyclic nature of operation, like 3 months operation are there or 6 months operation are there, then they are required to disclose in the financials. There are some operations which are more than a year. Seasonal operations like mango seasons are of 3 months or 4 months period. Winter season, the woolen garment seasons are in during the winter season. So seasonal nature of operations are also required to be disclosed. If the exceptional items are there, that also required to be disclosed. If there is a nature and change in estimates from last interim period or last annual period, if some estimates they are taken in last annual period or last interim period, but if the company wants to change the estimate, then the nature and the change is required to be disclosed in the current interim financial report. Disaggregation of revenues from contract with the customer. Contract with the customer means revenue. Revenue is of 100 crores. In that 100 crores, revenue from contract with goods and services. There is a disaggregation, and that disaggregation is required to be disclosed. Issue, purchase or repayment of equity and debt security. If there is a change in any capital structure of the entity is required to be disclosed. Fair value disclosure of the financial instruments. Fair value is required to be disclosed of the financial instruments. Event if occur after reporting period. If any event occur after the reporting period but during that interim period, then it is required to be disclosed. Business combination, loss of and discontinued operation, then it is required to be disclosed. Dividend paid or declared, then it is required to be disclosed. During that period, if any dividend paid or declared, then it is required to be disclosed. If an entity become an investment entity or it ceases to become an investment entity, in both the cases, they are required to be disclosed. Segment information as per Ind AS 108 is also required. So disclosure of all the compliances with Indian accounting standard is required to be disclosed in the interim financial. Means all the standards compliances is required to be disclosed. Now principles of measurements and recognition in the interim financial statement. Materiality. If the transactions are material, as we have taken the example of Reliance. Reliance is having an annual turnover of 40 crores. And during that interim period, if the transaction is of, if there is a transaction which is of 1000 crore, which is not material for the, but which is of 10,000 crore, then it is material. So materiality is checked not on annual purpose, but during that interim period, what transaction is material or not. Because in that quarter, if the total turnover is 10,000 crore, then 1000 crore is material for that period. But as a whole, it is not material for 40,000 crore. So we have to, the company needs to check the materiality quarter aspects from interim period aspects, not an annual. Revenue, seasonal, cyclical or occasional. It is to be recognized in the interim fine as it when it occurs. Means if any revenue occurs, when it occurs, it will be recognized then only. It is not recognized on a proportionate basis. It is recognized as and when it occurs. We have taken the example of snow removal companies. They have a peak season lasting only from few months in most cases. These companies are in northern states and typically operate from around October until May. From October to May they are operating to remove the snow from the land. Once all the snow has melted and weather warm up, their season is over. So their work is to remove the snow from the covered area where the snow fall, and their work is to remove that snow. So their operations generally occurs from October to May. Means quarter 3 and quarter 4 they are covering. In quarter 2 their work is totally shut down. In quarter 1 there is some like minimal. So almost their revenue is of 110 lakhs. So these 110 lakhs, whether it is to be required to be disclosed on a proportionate basis or as and when it occurs. As and when it occurs. If the revenue is occurring in quarter 1 is 10 lakhs, then it will be recognized in that quarter only. If in quarter 3 the revenue is means recognized as 50 lakhs, then it will be recognized on 50 lakhs only. And if they earn revenue of 40 in quarter 4 50 lakhs, then it will be recognized in quarter 4 only, not in any other. On a proportionate basis it will not be recognized. It will be recognized as and when it occurs. Then impairment in the interim financial state reporting. If the impairment is related to goodwill, then the goodwill is impaired in quarter 2. Suppose the goodwill is impaired in quarter due to losses incurred in the subsidiary, but in quarter 3 it got picked up and subsidiary got a huge order. For example, there is a goodwill in quarter 1 and in quarter 2 the goodwill is not there because the goodwill is impaired. If the goodwill is impaired and subsequent quarter the goodwill got picked up, then whether it will be recognized which is impaired, whether it will be reversed which is impaired in quarter 2, no, it will not be reversed because goodwill is not is reversed. Other than goodwill, if any other asset is there, it will be reversed, but goodwill is not reversed. Impairment of goodwill recognized in an interim period will not be reversed in the subsequent interim period even if they are occurring in the same year. So goodwill is not reversed. Other than goodwill, if any other asset is impaired, then that is reversed. Like we have taken the example of land. If the land is impaired in quarter 2 but by 20 crores and charged to P&L, but in quarter 3 the value of the land increased beyond the earlier carrying amount. Like in quarter 1 the value of the land is 10 crores, in quarter 2 it will be impaired and becomes 80 crores because 20 crores is impaired and charged to P&L. And then it will become in quarter 3 it become increased to 100 crores. So these 20 crores which is impaired earlier is to be reversed. Asset other than goodwill will be impaired in one interim period, will be reversed in other interim period if situation is favorable. The situation is favorable, it will be reversed, but goodwill is not reversed. Consistent accounting policy. The entity is required to follow the consistent accounting policy should be followed by the entity as they are followed in annual financial statement, unless there is some material changes due to issues of new standards or guidelines. Like if there is an issuance of new standard, for that the company is required to change some policies. For that the company is able to change, otherwise they has to follow the consistent accounting policy. This is to be explained by example. Suppose there is a issuance of new standard, that is 116, which is applicable with effects from 1st April 2019. So till 31st March 2019 there is no impact of Ind AS 116 because it will be effective from 1st April 2019. But in the next interim period, if the company is preparing the next interim financial on 1st April 2019, 30 June 2019, then they have to give the effect of Ind AS 116. They had to require to give the effect of 116. So for next interim, they are required to give the effect of new standard. Now income tax calculation in interim financial reporting. Income tax for the interim financial period is recognized or measured on the basis of best estimates of weighted average annual income tax. Best estimates of weighted average annual income tax rate expected for the full year. Means they have to make the estimate of weighted average annual income tax rate which is expected for the full year. This is to be explained by example. Suppose XYZ Limited has reported rupees 1 lakh as a pre-tax profit in the first quarter. The first quarter they know that the profit will be 1 lakh which is pre-tax profit, and in the next quarter they expect a loss of 20,000, and in quarter 3 also they expect a loss of 20,000, and in quarter 4 they expect a profit of 70,000. So they has a corporate slab rate will be 25% on first. They had to charge a tax rate of 25% on first, rupees 1 lakh of annual earning, and 40% on all additional earning. Calculate the amount of tax to be shown in each quarter. What tax they are required to show in each quarter. So expected income for full year will be quarter 1 will be the 1 lakh, quarter 2 loss of 20,000, quarter 3 loss of 20,000, quarter 4 profit of 17. In total, the full year estimated profit will be 1,30,000. Now the calculation will be on the first 1 lakh, the tax bracket will be 25%. So first 1 lakh into 25%, that is 25,000. Remaining 30,000 will be charged at rate 40%. 30,000 into 40% will be give rise to 12,000. So it will total tax will be 37,000. Now the calculation of weighted average rate of income tax, that is total estimated tax for the full year, that is estimated divided by total estimated profit. So estimated tax will be 37,000 and total estimated profit will be 1,30,000. So the rate weighted average rate of tax will be 28%. Now calculation of tax in each quarter. Now quarter wise income, average tax rate and annual amount of tax. That is quarter 1 the income will be 1 lakh, average rate will be 28%. So amount of tax will be 28,000. In quarter 2 the loss of 20,000, that is average rate will be 28%, that is, and quarter 3 loss of 20,000, 28%, that is 1,600, and in quarter 4 70,000 income at the rate average rate of tax will be 28% and it gives rise to 19,600. So total income will be 1,30,000 and that tax amount of tax will be total tax will be. In this way we will calculate the each quarter wise tax, and the total annual tax will be 36,400, and in quarter wise the tax will be 28,000 in quarter 1, quarter 2 5,600, quarter 3 5,600, quarter 4 19,600. In this way the amount of taxes to be calculated quarter wise. There is one example also related to interim financial reporting. ABC Limited manufacture automobile part and has shown a net profit of rupees 20 lakh in the second quarter 2022. The profit of 20 lakhs is related to quarter 2. Following adjustments are made while computing the net profit. Bad debt for rupees 1 lakh incurred during the quarter. During this quarter, there is a bad debt of 1 lakh. 50% of the bad debt have been deferred to the next quarter. Means from 1 lakh, the company wants to defer the 50% of bad debt to the next quarter. Whether it is possible? No, it is not possible. The event or the transaction which occur in that quarter is required to disclose in that quarter only. It is not required to be deferred. Additional depreciation of rupees itna resulting from change in method of depreciation. Yes, they had made an additional they had made a additional depreciation which they had disclosed. So it's a correct. Exceptional loss of 28,000 incurred during the year. If there is a loss of 28,000 during the second quarter and they had disclosed the 50% of that, but they had not disclosed the remaining 50%. They want to disclose, they are disclosed in the next quarter. Whether they had done the correct entry? No, it is not correct. The event which occur in that quarter is required to disclose in that quarter. So they have to disclose the full 28,000, not the 14,000. Rupees 5 lakh expenditure on account of administrative expenses pertaining to the second quarter is deferred on the argument that the third quarter will have more sales. Therefore, the third quarter should be debited by higher expenditure. The expenditure are uniform throughout all the quarters. Ascertain the correct net profit to be shown in the interim financial report of the second quarter to be presented to the board of directors. So, in this way they make a solution. Net profit of the second quarter will be 20 lakhs. Adjustment, that is bad debt. Bad debt, because the total bad debt incurred is 1 lakh, in which they had given 1 lakh 50,000 effect, but they had not given the remaining 50,000 effect. So the adjustment of 50,000, 50,000 adjustment is required to be given, the effect of that. Additional depreciation they had done because of the change in methods, they are disclosed, so there is no adjustment. Exceptional loss which they are deferred, because 14,000 they had booked, but remaining 14,000 they are deferred. So remaining 14,000 which they are deferred is required to be adjusted. 5 lakh expenses, administrative expenses which they defer to the third quarter is also required to be adjusted. So they had adjusted 50,000 for bad debt, 14,000 for exceptional loss, and administrative expenses 5 lakh. In total, it will be 5 lakh 64,000, which is to be reduced from 20 lakhs to get the correct quarter net profit. Will give a 14 lakh 36,000. So this is the illustration. This standard is a small standard. It's completed. Now, thanking you for watching my video. If you like, please subscribe, share my channel.